All right, let's just jump right into this. Welcome to the Explainer. Today, we're tearing into the July 2026 data drop. And honestly, there is one massive, glaring headline that we have to talk about right now. The two America's housing crisis. We are seeing an absolute record divergence in the July numbers, a literal split in the U.S. housing market. We're going to break down exactly what just happened, why it actually matters, and what it means for your portfolio.
Because look, you have to ask yourself, is your wealth actually prepared for this kind of data divergence? Think about the extreme fractures we're dealing with this month. On one hand, you've got this wild fever pitch of AI hype just vacuuming retail money into the stock market. But then on the other hand, you've got this historic, massive split in U.S. real estate. We're talking cities hitting all-time highs, while others are just falling off a cliff. If you're managing your own money, you need a game plan for this. The old playbook of just, buying a broad index fund or a random piece of real estate and waiting for it to go up, yeah, that's being severely tested right now.
So, here's our roadmap for today's Explainer. We'll start with AI and overleverage, then move into these new real estate realities, check out some massive wealth and policy interventions, and wrap it all up with the macro gold rush. All right, part one, AI and overleverage. AI isn't just a tech story anymore. It's literally rewriting the rules for how everyday people handle their money. Take OpenAI's new dedicated finance pilot. For $200 a month, you basically get what feels like a full-on financial advisor. And the pros? Pretty obvious. It's totally democratized, it's there 24/7, and let's be real, it's a completely judgment-free zone, which means people are actually being honest about their terrible spending habits. But we really need to look at the cons here. In benchmarking tests for complex finance tasks, this AI is throwing a 17.5% error rate. In the financial world, a hallucination isn't just some funny typo, right? It's a bad recommendation that could literally tank your life savings. And here's the real kicker. Unlike a registered human advisor, an AI has zero fiduciary duty. It is not legally required to put your best interests first. And this whole AI frenzy, it's throwing gasoline on a very dangerous fire. U.S. margin debt, which, remember, is just borrowed money used to buy stocks, it just hit an all-time record of 4.5% of GDP in June 2026. That blows right past the peaks of the dot-com bubble and the 2008 financial crisis. No joke. If you want to see the risk play out in real time, just look at the recent crash in the South Korean stock market. Retail investors over there got heavily leveraged into just two massive AI chip stocks. When the market finally corrected, 1.2 million margin accounts were forcefully liquidated. Poof. Because when you invest with borrowed money, you don't get to politely decide when to sell. Your broker auto-liquidates you the second prices drop, and that triggers a vicious, devastating doom loop. Okay, moving on to Section 2, Real Estate Realities.
We're pivoting now from digital tech bubbles straight into physical assets, and this brings us to the absolute most urgent data of the month. To truly grasp the scale of what's happening globally, we have to start with China. We're talking about an estimated $18 trillion just completely evaporating from their real estate market. That is 20 years of housing growth wiped out. They built millions of units that are just sitting there unfinished because the money printer that kept those developers alive got abruptly unplugged. Now, prices have been falling for 35 straight months.
Now, before you hit the panic button and start bracing for a 2008-style collapse here at home, the data actually shows a really crucial difference. In China, an unbelievable 70% of household wealth was locked up in real estate. It wasn't just an investment, it was basically the only investment. Here in the US, that number sits around 25%. So our economy is way less concentrated in that single asset class, meaning a total systemic wipeout like we're seeing overseas is highly unlikely here. But that definitely does not mean our housing market is stable. And that brings us to the main event, the July 2026 housing divergence. Economists are literally calling this the two Americas housing market. Unlike China, the U.S. has a massive supply shortage. We're short roughly 1.2 million homes right now. Plus, you've got American homeowners sitting on these 30-year fixed-rate mortgages, mostly locked in way under 4%, so nobody is being forced to sell. But regionally, we're seeing a record historic split. Markets in the Northeast and Midwest are absolutely booming. Take Hartford, Connecticut, it's actually up 25% from its peak. But then look at the pandemic boomtowns down in the Sunbelt. They are busting hard. Austin, Texas is down 27% from its peak thanks to a huge surge in inventory and sellers slashing prices. The national numbers are completely bifurcated. So for retail investors, assuming that real estate just always goes up everywhere is an incredibly dangerous bet to make right now. All right, let's look at Section 3, Wealth and Policy Interventions.
So as all this wealth is shifting wildly across real estate and tech, how are governments actually responding? Let's hop just across the border to Canada to check out some fascinating and honestly super heavily debated policy interventions. You've probably seen those viral posts flying around social media claiming Canada's going to confiscate 60% of your wealth if you try to pack up and leave. Let's just neutrally look at the actual mechanics here. Canada has what's called a departure tax, which is technically a deemed disposition. Essentially, the government just pretends you sold all your assets the day before you leave just to capture those unrealized capital gains. It's absolutely not a flat wealth confiscation. The maximum capital gains rate is roughly 26.65% depending on the province. And here's the big thing. Canadian real estate? Entirely exempt. Registered retirement accounts like RRSPs? Exempt. It mostly hits non-registered investments and private business shares. The whole idea is just to stop people from racking up massive gains in Canada and then bolting to a zero-tax haven just to cash out.
Alongside that tax, Canada also just proposed a brand new sovereign wealth fund, the Canada Strong Fund, to help pay for private infrastructure projects. But if we compare this to the ultimate gold standard of wealth funds, which is Norway, you start to see some glaring execution risks. Norway has a staggering $2 trillion fund. How they get it? Actual cash surpluses from their nationalized oil, and they invest it entirely outside of their own country to diversify their risk. Canada's proposed $25 billion fund, on the other hand, is being funded by government borrowing because the country is currently running a deficit and it plans to invest completely inside its own borders. Borrowing money to make highly concentrated domestic bets, that introduces a totally different level of risk for the taxpayers who are ultimately footing the bill. Speaking of risk, as everyday investors are trying to figure out these crazy housing trends and new tax laws, a lot of them are turning to social media for answers. And honestly, the data here is a little terrifying. 61% of investors aged 18 to 34 are making actual financial decisions based on social media influencers. We're seeing this massive explosion of illegal finfluencer promotions. You have these zero-revenue mining companies and unregulated crypto prediction markets secretly paying creators to pump up these super risky bets. Some of these shady companies are even using AI-generated avatars now just to avoid paying real human beings. It is an absolute minefield out there right now, folks. You have to be incredibly critical of where you're getting your financial advice. Okay, final part. Section 4, the macro gold rush. Let's zoom all the way out to the global macro stage. With these volatile housing markets, massive retail leverage, and governments shifting policies left and right, how are the real heavyweights, the central banks, reacting? Well, to understand today, we kind of have to look at the timeline of global industry. Way back in 1791, the U.S. used Hamiltonian economics, basically tariffs and subsidies, to build up this massive industrial base. Fast forward in 1971, the U.S. drops the gold standard. That kicked off a highly financialized economy where it was just cheaper to offshore all the manufacturing and just print paper assets instead. Well, jump to 2026, and the U.S. is actively trying to pivot right back to Hamiltonian policies to rebuild local factories. And because of this massive structural policy shift, foreign superpowers are getting pretty nervous about holding so many U.S. dollars. As a direct result, we are seeing China aggressively buying physical gold for 20 straight months, locking down a neutral reserve asset that absolutely no single country can just print or control. And that brings us to a truly wild, albeit, highly theoretical, mathematical model that's bouncing around macro circles lately. The theory goes like this. If the current global financial system were to actually fracture, and a country like China decided to settle its massive $1.2 trillion trade surplus entirely in gold instead of US dollars, well, at their current import rates, the price of gold would mathematically have to hit roughly $38,000 an ounce just to balance the books. I know. That number sounds totally astronomical, but it perfectly highlights just how drastically mispriced hard assets might actually be if the global economy fundamentally revalues away from the dollar. All right, we have covered a ton of ground in this explainer. Let's synthesize this whole global tour into some level-headed, actionable advice for you. Number 1, diversify. Seriously, do not park all your wealth into one single tech stock or one regional housing market, especially knowing what we just went over with that two America's divergence. Number 2, avoid over-leverage. Margin debt is at record highs. Do not be the one who lets their portfolio get forcefully liquidated when the music stops. Number 3, always verify your financial advice. Remember, an AI chatbot and a YouTube influencer do not have a fiduciary duty to protect your money. And finally, number 4,
Understand the actual tax mechanics, like those departure taxes, before you make any major life moves. I want to leave you with one final provocative thought today. We are watching a historic transfer of wealth and strategy happen in real time. On one side, you have central banks and global superpowers literally hoarding neutral physical assets like gold. Meanwhile, millions of everyday retail investors are maxing out their margin debt just to gamble on AI hype and heavily concentrated paper assets. So, looking objectively at the data, which side of the trade are you on? Thank you so much for joining me for this explainer, and I highly encourage you to keep questioning the data as this wild market continues to evolve.